What's up, everyone? It's Karthik with MoneyVest. So Palantir and SOFI stock selling off, both of them on the day from 3 to 5% respectively. Palantir was down a little bit over 3% and SOFI selling off over 5%, down to as much as $7.16. Palantir is coming out with their earnings very, very soon, pretty much next week. So Monday, August 5th is when they are going to be reporting. You can pretty much take a look at that on our earnings calendar as well. So these are all the companies that have already reported. Of course, tomorrow, pre-market, we've got Exxon, Chevron reporting, so two big energy giants. And then next week is when Palantir is scheduled, as you can see, on Monday, August 5th. And the reported, or the expected revenue is going to be $665 million, with earnings per share expected at 8 cents per share on a non-GAAP basis. So that's going to be available on Monday, August 5th, excuse me. I'll be doing a video prior to those numbers coming out as well. We've also added a brand new feature on our MoneyVest platform. Again, if you want to get access to this platform, as well as members-only private videos and all the trade alerts and trade ideas, link's going to be down below. We'd love to have you on board. And I'm also sharing this spreadsheet for free, and that's what we're going to discuss in this video if you want to download and, of course, play around with these numbers yourselves. So link's going to be down below for this spreadsheet as well. I'm going to be explaining why it is so important to understand the concept behind leaps. Leaps are longer dated options, especially over 1 year out, and why it is going to be quite interesting for Palantir, SOFI specifically if you are bullish on these two companies, right? So Palantir, SOFI, of course, is going to be the topic of discussion today, and we're going to discuss why, if you are bullish, let's say 2 years out, there is potential with leaps as well. I'm going to explain and also go over some of the analysis with these options. So first of all, Palantir selling off down about 3%. As we have already discussed, it is still within the context of this uptrend of higher highs and higher lows. If you come over to this chart for those two companies, this is the actual technical analysis, as we have gotten rejected at $29 as discussed in my yesterday's video. Both SOFI and Palantir have over 70% of investors in the green right now, although might be a little bit lower after today's sell-off here. But this is a very, very important area of resistance that we need to watch for Palantir. That's, it's gotten rejected here once, twice, 3 times, 4 times, multiple times. It's struggled to break out of that supply. And a lot of you guys also wanted me to include the price by volume chart, so we can do that all the way up till where the price is trading. You'll notice that majority of the volume has come in at a price closer to $24 to $25 a share. You can see that max volume has arrived at $24, $25, and the second largest volume bar is sitting in this range between $7 to $8 a share for Palantir. So it's actually quite interesting that since inception of its IPO, majority of that volume for Palantir sits somewhere between $7 and $8. Second most volume price here, and the first volume, of course, sitting very close to $24, $25 for this stock. So still within the context of this uptrend, as I would like to call this, is a very, very nice consistent uptrend here, as we are seeing with Palantir, massive resistance and supply where it's getting rejected at $29, and we've got a very nice support as marked out from this higher low. That's going to be that ascending support, as well as inside this green rectangle, that area of confluence sitting roughly around $20 per share as well for Palantir. Coming over to SOFI, and this right here is the overall sort of technical breakdown. I've mentioned the descending triangle in my previous videos and how it's getting rejected at these lower highs. As you can see, that it was down almost a little bit over 5% on the day. So this right here is the lower highs, and it continues to get rejected at those levels. And the next support, very important level, is going to be sitting roughly here at 640. So 640, very important support level for SOFI. $20, very important support for Palantir. And if we mark out the price by volume chart for SOFI, so this right here is going to be that IPO from back in December of 2020 till now. Majority of that volume has quite literally arrived at this price. It's actually quite insane. Very, very low volumes, but it's good to see that majority of that volume has come in at prices closer to where it's trading at the moment in the $6, $7 range. It's actually quite crazy that the max volume is pinpointing to this exact resistance where we are trading for SOFI. So that's exactly where it's getting rejected, and that's also where the volume has maxed out for SOFI between $7 and $8. More precisely, $7.75 is where the max volume is. And support level, like I said, next is going to be $6.40. And that's also somewhat of the range where the next biggest volume bar is for SOFI in terms of prices. Now, I wanted to go over leaps in this video. By the way, do connect with me on Instagram if you want to enter into a chance of winning our courses for free. So we've got 4 courses. That's a bundle worth almost $1,900. So if you want to enter into a chance of winning, we're going to be doing a free giveaway. Just follow me on Instagram. That's going to be CastWRP. Would love to connect with you over there. So for those of you who don't know, long dated options such as leaps are also a good way to control 100 shares of a stock if you are, let's say, bullish on that company, on that stock for the long term. And when I say long term, I'm talking more than 1 year out, but less than 2 years. So this spreadsheet is going to be available for you to download. It's free. So all you have to do is just click on the link down below in the pinned comments, and it'll take you to that Patreon page where you can sign up for free and download the spreadsheet for yourself. And the reason I'm sharing all this is because I want to really help you understand. And this is more of an educational video than it is on analysis. I've done a similar video on cash secured puts, which you guys seem to absolutely love. It's one of the best performing videos I posted. So this is going to be something similar where you understand the concept behind leaps and then take advantage, play around with the numbers, not only Palantir, SOFI, but also do your analysis for other stocks as they are selling off, as the markets are coming down. You can figure out, okay, whether it makes sense to buy a leap or straight up buy stock. So if you come over to this calculator, let me just go over how it works. So inputs are in blue. So everything in blue is going to be an input. Everything in black is going to be an output, right? You don't have to calculate it. It's going to calculate itself. So let's start with Palantir, right? So this right here is Palantir. I've already put in today's date. So in fact, I should just turn this into black because this is already going to update. I've already put in the formula. That's going to be date here today. Ticker symbol, you can plug in for yourself. Quantity, you can plug in for yourself. 1, 2, 3, however many contracts you're looking at. Remember, one contract is 100 shares. Action, again, buy or sell. Most likely, since we are doing leap contracts, that's going to be a buy. Type is going to be leap. So all that information is going to be laid out perfectly. Now, you also want to plug in the price, right? So price for the actual stock that you're looking to trade. In this example, I am focusing on Palantir. So Palantir, since it's trading at $26.08. That's where it closed. If you come over to Palantir, you'll notice $26.08. That's the closing price for today. I've plugged in that price here. And now with the leaps contracts, what happens is that you're looking at deep in the money call options as far as you can go. Okay? That's the whole idea behind leaps. Ideally, it's a little bit over 1 year out, but the proper way of constructing a leap is to go as far as out possible. So for example, the longest we can go out for Palantir for an expiration is 868 days, right? That's over 2 years. That's December 2026. December 2026, right? So December 2026, and that is also deep in the money, right? The reason why we go deep in the money is that's where you're going to get the delta, which is over here, as close to 1 as possible. And the reason why we want the delta as close to 1 as possible is because a couple of things. Number one, it's a probability outcome as well, right? The probability of this contract expiring in the money is over 91% by expiration. That's exactly what we want, meaning that there's a high likelihood that this contract is going to be in the money by December 2026. Number two, if it's closer to 1, that way we're getting a very, very close stock price movement to the option price as well. Right? Because we're not actually buying 100 shares of Palantir stock in this example. If Palantir goes up by $1, right, we want our option contract also to go up by $1, right? In this case, it's going to go up by 91 cents to be very precise. So we want this number to be as close to 1 as possible, and we want to go deep in the money with the lowest possible strike that is available, right? And I'll explain certain things where there is a balance that you can find. You can even come down a little bit on the strike. You can go $15, $18 strikes, but then of course you can see the delta is coming down. So you may not get that 1-to-1 correlation for the option price with the stock price, right? You want to get a very close to that correlation so that we're getting the same amount of movement in the option as it is with the stock price. So in this example, let's just say that we want to pick December 2026 $13 strike, and right now you'll notice a bid is $15.75, ask is $16.35. Those are premiums, right? Those are the premiums. That's the cost of this option. The bid price is of course the buyer, the sell price is the ask, and since we are going to be on the buying side of this option, this is perhaps the only time I would consider buying options is when I'm buying leaps. Then I would be looking at $16.35. Of course, the markets are closed right now. So these numbers can and will fluctuate when the market's open. But let's just say for this example, we're plugging in $16.35. So $16.35 is the premium. That's what I've plugged in over here. You can see $16.35. Strike is $13, right? And the expiration is December 18th, 2026. So I'm going to come over here and I'm going to update this to 12/16/2026, right? So December 18th, actually, December 18th, 2026. So there we go, December 18th. And automatically it's going to calculate the number of days, right? Days expiration, 868, because that's the today's date minus the future date, 868 days. So once we have plugged in all this information, what do we get? We immediately get a cost analysis, right? So cost is 63%. So what that means is if you go out there and buy 100 shares of Palantir, right, you would be spending $2,600 because right now this is the market price. This is the market price, right? $26.08. So if you buy 100 shares, you'd be spending $2,608, right? But if you buy a leap, right, for Palantir, that's only going to cost you $1,635 because that's the premium, that's the ask of that option that you'd be paying, right? So that is 63%. That's $1,635 is 63% of the cost of buying 100 shares. So automatically, it is significantly cheaper to buy 100 shares, right? So buying one contract, buying one leap contract of a stock is cheaper in most cases than buying 100 shares of that said stock. So 63% is going to be that cost because your debit will be $1,635. The ideal preferred is less than 60%. As you can see that I've put that in. Right now, 63%, that's just 3% over our preferred number. So that's okay. Maybe if the prices continue to come down, then that number can also come down with it. So that's something you can keep a track, right? You can keep a track of it and where the cost is of 100 shares versus the cost of buying a leap contract. Now, I've also broken down the intrinsic value and the extrinsic value, right? I've broken all this down in a lot more detail in our options course. I'm not going to get into too much detail, but really what you have to understand is that if you were to, let's say, take this options contract, because it's deep in the money, it's in the money already, right? And you as the buyer have the right to exercise. So if you take this deep in the money contract, and as a buyer, you have the right to exercise. You exercise it right away, right? You buy this contract today, you exercise it today. What your loss is going to be immediately is going to be $3.27. In other words, $327. That's the extrinsic value built into the contract that you will be incurring a loss with if you were to buy this and exercise it on the same day. That would be stupid because nobody would actually do that, right? Because that would be just throwing money away. And this number will also never be a profitable number, right? You will not be in a market where you just buy a deep in the money contract and then immediately sell it for a profit. If that were the case, the markets would never be efficient, right? Because there's time value of money that needs to be built into those contracts. And that's exactly why the extrinsic value is there of $3.27 in this particular contract. Now, what we really ideally prefer, the extrinsic value as a percentage of premium to be about under 4 to 5%. I want to say under 5% ideally. Right now it's at 20%. So in other words, the extrinsic value, which is $3.27, is over 20% of the premium. So $3.27 is 20% of $16.35. That's the premium. We want this number as less as 5%, and I'll explain why. Because whatever we're saving, right, from investing in a leap contract versus investing in 100 shares is the number that we're saving that we can then use to generate even more return, right? So it's going to make a lot of sense here as I explained to you over this. So as I said, cost of owning 100 shares of Palantir, $2,608 because that's the market price. $26 is the market price. So if you buy 100 shares, $2,608. Cost of buying one leap is $1,635. So the savings you have, how much money you're saving is $973. $973, right, is your savings. Now, as I mentioned earlier, if you buy this contract and exercised the same day, right, you would incur a loss of $327 because that's your extrinsic value. Now, how did we come up with that? Let's just think about it logically. If you buy a deep in the money $13 strike call on Palantir, exercise the contract right away, you will own the shares at $13 for Palantir. You will own 100 shares of Palantir at $13, right? and you'll be able to sell it in the market for $2,600, right? Because the market price is $2,608. So your cost will be $13. Market price will be $26. So that difference is going to be your profit, right? The difference is going to be your profit. So upon exercise, you can make a profit of $1,308. That's going to be your profit upon exercise. But wait, what did you pay to get the right to buy 100 shares at $13? You paid $1,635, right? That was your premium. That's how much you paid to get the right to buy 100 shares at that specific strike. That was $1,635. So you paid $1,635 to obtain the right to buy the shares at $1,300, which then you exercised and then sold in the open market. So your actual net profit is indeed a net loss of $327. And that $327 divided by 100 shares, because one contract is 100 shares, is back to the extrinsic value of $3.27. Hence the extrinsic value built into the contract, because it's not a profitable game from day one. And so the analysis that we like to do, and all of that is going to be laid out in this calculator, is the extrinsic value yield, which I can tell you not a lot of people are talking about this during Leaps videos or Leaps analysis. The reason why this is extrinsic value is so important because the savings that you have by buying a Leap versus buying 100 shares of $973, how much do you need to make from those savings in order to make back the extrinsic value? And that is 33% over 2.5 years. So if you really just divide this over, let's say 2.5, we're looking at 13%, 13.4% per year is the rate of return that you need to generate from those savings in order to make back the extrinsic value built into this contract, which is slightly above the market of 8%. So hope that makes sense. For me, this is a contract that is okay. Ideally, this would, I would want the extrinsic value as a percentage of premium and the yield to be as low as possible, because that tells me that whatever I'm buying, whatever contract I'm buying, mostly has intrinsic value built in and not extrinsic value, which is a supposed loss if I try to exercise that contract. So of course, as time goes on and as the stock price, let's say, move higher and higher, I will be more and more in the money, and as a result, eventually profitable, right? And you can see the break-evens also included. So break-evens $29.35. That means Palantir by December 2026 needs to be above $29.35 in order for me to make a profit on this trade. And this is nothing but a addition of the price with the extrinsic value. Or you can also come up with this number with the debit that you pay, the premium that you pay, and your strike price. So in other words, if you simply add up your strike, which is $13, plus the premium you paid of $16.35, you arrive at the same exact break even of $29.35 as you would with the market price, which is around $26 plus the extrinsic value of $3.27. So those two numbers are the exact same formula. This is just nothing but strike plus premium paid. This is market price plus extrinsic value. So those are the same exact formulas that you can come up with the break-even price on the actual stock. So in other words, by December, if you believe that Palantir is going to be above $29, this is a potential leap that can cost 63% only of 100 shares that can benefit you. So you can do a very similar analysis on SOFI. That's going to be available here. You can, of course, take a look at it. Now, the numbers I feel like are a little bit different because SOFI's got a very, very significant spread on the bid and the ask. And that's probably because the markets are closed right now. So if you come over to SOFI, go over to Deep in the Money, you can see that $1 call is selling for $6 and $7.55. So that is a pretty big spread, right? $1.55. So as soon as the market's open, and the cool thing is, and the interesting thing is that this actually does not make sense, because if I were to buy this contract for $7.55, why do that when I can buy SOFI at $7.16, right? So the actual cost of this option is greater than the cost of buying 100 shares. So it doesn't make sense. There's no cost reduction. It's not cheaper to buy a leap on SOFI than buying actual shares. But this number, of course, will fluctuate when the market's open. Now, the benefits of buying leaps are very, very significant. So this right here is a quick breakdown of buying leaps. So it actually has downside protection. So whatever your strike is, if the option contract, if the actual market price goes below your strike, The max you lose is the premium that you paid. That's it. The premium that you paid is the max loss that you have. So it actually has a downside protection. Doesn't matter how low the stock price goes. Doesn't matter if it goes down to zero. You have downside protection. It has limited downside risk. So as I said, you've got maintained, you have the premium, that's the max that you can lose, and unlimited upside reward. If the stock price goes up to 100, 200, 500 in the next 2 years, you've got all that upside potential with very, very limited downside risk. It's cheaper than buying shares in most cases. In Palantir's case, it was 63% of the cost of buying 100 shares. So it was 37% cheaper than buying 100 shares of Palantir. But in SOFI's case, the actual cost is higher than buying shares, right? So it doesn't make sense. Almost identical stock movement. So delta, very, very important concept there. We want to get that delta as close to 1 as possible. There are certain cons. It is very, very time restricted. So let's say that you've got a 5-year time horizon on Palantir or SOFI, or a 10-year time horizon on any company, then of course you won't be able to take advantage of that because you're time restricted by that option contract. If you're buying a leap, you can only go as far as 800-900 days, max 1,000 days, and that's about it, right? So your trade has to work out in that time period. If it doesn't, then of course you're just holding on to a trade that doesn't make any money, and it may not be applicable for all stocks. Not all stocks may have the ability to buy leaps on them. So the bottom line is this is going to be available for everyone to download this spreadsheet, do some analysis. Hopefully this was helpful for you to understand. But bottom line is, coming back over to the actual prices, keep a close eye on SOFI as this descending triangle continues to play out. Resistance going to be at 775, support at 640, and then of course coming back over to Palantir, very much in the context of an uptrend. Very nice move to the upside, higher highs and higher lows. Anywhere between $20 and $23 are going to be good support levels to watch, and I will be looking at potentially buying leaps on Palantir for the next 2.5 years. As I do believe that it's got a ton of potential. Profitability, in my opinion, is going to be much higher in the next 2.5 years, and there's possibility that it's going to be way above $29 in the next 2.5 years. So hope you all enjoyed this video, found it helpful. Make sure that you drop a like and subscribe to the channel. Hopefully this was of value and you got a little bit of an education on buying leaps and what that leaps are all about. Link's going to be down below if you're interested in joining us, and as always, happy investing. I'll see you all in the next video.